Hi, friends. Welcome to the Skinny on Wall Street with us, the Wall Street Skinny. I'm Kristen,
I'm Jen.
and this is our second weekly podcast episode where we give you a rundown or the skinny on anything that happens to be going on in the markets. And so we basically normally do these on a Thursday or Friday. Last week, we got super caught up with we're trying to get our course out and it's been a shit show. But this week, in light of what has been happening, I mean, anyone who has been reading the news or following along. I mean, literally the Daily did an episode today, which is the New York Times. They basically have a different big story every single day. And the big story was what's going on in the markets. And so we thought it was really important to come on and basically touch on exactly what's going on. I mean, as Jen said, this is essentially a macro trader's wet dream. So we're going to be talking about all the volatility going on in the market.
I said that offline.
Whatever. We have an explicit rating on here.
Kind of gross.
No, so we're going to be going into kind of like what has been causing the insanity in the markets, the massive amounts of volatility. There's also this, it's labeled the SHAM rule, which anyone who is like a mom has seen this online abbreviated as like SAHM, stay-at-home mom. That is not what this is. But when Jen first messaged it to me, I was like, the stay-at-home mom rule. What's that?
My phone auto-corrects. If I try to type SAHM, SAHM, it auto-capitalizes it because I've only ever used it as an acronym. It is a woman's last name, not her profession.
It's like she's like a genuine, like real economist. And so anyway, Jen's going to talk about that. Again, it is a recession indicator. It was stripped last week. So she's going to walk us through that. If we have time, I'd love to just touch really quickly. We're not going to do a deep dive, but just talk a little bit about sort of the failed Pershing Square US IPO, which is Bill Ackman's closed-end fund he tried to take public. And then I really want to wrap up with Ballerina Farm. And if you have no idea what that is, it's this wild story. So with that, I am going to hand this over to Jen, who's going to start to basically take us through all the crazy stuff that is happening right now in the markets.
Well, thanks, Kristen. I feel like we're running a news show here. Okay, so it was actually a blessing in disguise that we didn't do an episode last week because I would have had very little to say, and now I have much more to say. So last week, the Fed had their regularly scheduled meeting, and they kept rates on hold, which is exactly what the market was expecting. But the chairman of the Fed, Jerome Powell, basically gave the markets the like wink, wink, nod, nod that they'd been looking for, that they were very likely to cut rates in September. Okay, so what happened? We got a classic risk on move. And risk on is just buy everything, okay? Stocks are like, woohoo, because if rates go down, it encourages investors to move their money out of safe and boring stuff like treasuries into higher risk, higher reward, higher yielding stuff like equities. Front-end bonds also got a boost because when the Fed lowers rates, you want to own a bond that pays you a higher interest rate that's going to be worth more when rates go down, okay? Cool, everything's hunky-dory, no problem. Well, that same day, to I think like much less fanfare here in the US, because let's face it, most investors are not always watching what's happening in the global markets. The Bank of Japan hiked rates, and they announced that they'd be cutting their bond buying program in half. We're not going to get into their balance sheet just now, but go ahead.
I was going to say, and like when we say that they hiked rates, it went from like 0 and they hiked it like 15 basis points.
Their range was 0 to 10 basis points. And remember, a basis point is 0.01%. So rates went from 0 to 10 basis points to now 25 basis points, which sounds like nothing to us. But remember, until March, Japan was the last global economy with negative rates.
Yeah.
And unlike equities, interest rates can go negative, right? Mm-hmm. So you can actually get to a point in an economy where you borrow money from me, and instead of paying me interest, I pay you to borrow my money. It's pretty wild when you think about it. We're not going to get into negative rates right now because anyways, they hiked rates to 25 basis points, okay? And remember, rates have been 0 there or negative since 2008. Everyone else who cut rates during the global financial crisis has since normalized monetary policy to some degree. So the BOJ seems like really late to the game by comparison.
Yeah.
And now they're seriously starting to ramp it up. So on Wednesday, when they hiked, the market was only pricing in about a 30% likelihood that they were going to hike. So the pace of normalization is a little bit faster than expected, even though they've been signaling that they're headed down that path. And when they did it on Wednesday, everyone was high-fiving about it, right? Mm-hmm. The Nikkei, which is the main stock indicator for Japan that most people watch, just like people watch S&P 500 here in the US, That was up on the announcement initially. And then over the next few hours, few days, everyone seemed to have a little bit of a change of heart. Okay. Like, wait a minute, faster than expected. Policy normalization is terrifying. Why? Well, think about it this way. The yen, when you hike rates, the yen is going to strengthen against other economies that are either keeping rates on hold or lowering rates, namely the US dollar. Okay, those central banks are signaling moves in opposite directions. And foreign trade accounts for something like 50% of Japanese GDP. It's a huge driver of growth, and a stronger currency hurts that. And whenever you have global central banks moving in opposite directions, like remember when the ECB hiked rates in the summer of 2008, right before the global financial crisis, you can definitely expect volatility at the very least, if not a total shitstorm, which is ultimately what we got. But also, okay, keep this in mind. It wasn't like the BOJ was hiking rates in the face of like massive, overwhelming growth and like amazing employment data. This was mostly a reaction to inflation. So think about hiking rates during a period of like meh growth, right? What does that mean for your consumer? Think about this too. Something like 70% of Japanese mortgages are floating rate mortgages. Like the BOJ knows this. This isn't a surprise to them. But just to give American listeners an additional perspective, in a cooling economy, that's going to hurt Japanese consumers much more so than, say, a corresponding hike in the US because the transmission mechanism is different. Okay. Most US mortgage rates are fixed for the better part of 30 years. So, okay, given all this context, the Nikkei, again, the Japanese equity market, started to sell off. It was down on Thursday and it was down again on Friday. Now, remember, Japan goes home for the weekend. They are 12. I think actually Tokyo's like 13 hours ahead of New York because of daylight savings or whatever.
Okay. Yeah.
So they're home. They're enjoying their weekend before the Friday employment data comes out. So we talked about non-farm payrolls before in the past. I think it was episode 56 where we explained the basics if you need a refresher.
Yeah, we'll put the link in the show notes too.
Perfect. But like TLDR, okay, non-farm payrolls, it gives us insight into the employment piece of the Fed's dual mandate, which is to keep prices stable, like AKA keep inflation in check, and to maximize employment.
Yep.
So the payrolls number came out on Friday and it wasn't great. The headline number was a miss. It was like 114,000 versus 175,000. I remember seeing that and being like, whatever, it's a miss. Like, let's see what the revisions are next month. Not the end of the world. But here's the kicker, okay? The unemployment rate ticked up to 4.3 and it triggered something called the SOM rule. And like you said, Kristen, it's SAHM. It's Claudia Somm is the name of the Fed economist or former Fed economist who came up with this quote unquote rule. And I think
opposite of a stay-at-home mom.
Yeah, the opposite of stay-at-home mom, exactly. It's something I'd never actually heard of. Like back in my day, all anybody cared about was the Taylor rule. And the Taylor rule is just a straight up equation. And what it does is it prescribes an optimal nominal federal funds rate given whatever the current rate of inflation is and how far off it is from 2%. And then current GDP growth as a differential between that and like the linear, and basically the output gap, okay? Apparently, what Claudia Somm did was she looked at historical unemployment data as a predictor of recessions and determined that when the 3-month moving average is more than half a percentage point above the low of the previous 12 months, that's the start of a recession. And apparently it's batting 1,000 since the 1970s. But you know what else is batting 1,000 since the 1970s? The inversion of the yield curve, meaning when front end rates are higher than long end rates in the US Treasury market. So if you take the yield on the 10-year US Treasury, for example, and you subtract the yield on the 2-year US Treasury, if you get a negative number as a result, that has predicted a recession within the next like 18 to 36 months since the 1970s as well.
So said differently, Friday, you're looking at the slope instead of going up in like a upward sloping angle, it is going down in a downward
exactly.
angle.
So until Friday, the 2s-10s curve in US Treasuries has been negative for over 2 years, I think, at this point. So when we got the SOM rule triggered by the unemployment rate, now the markets freak out because they're like, okay, this long-feared, long-awaited recession that we've been talking about potentially being in the cards for the past 2 years is here. On top of that, remember, we just rounded out earnings season. that Kristen had talked about with all of the tech companies. And we all know that big tech is effectively what's been propping up the US equity market for the past however long in this cycle, right?
Right.
So when we get the payroll report, all of a sudden, it's not like the risk on market vibes we got on Wednesday when everyone's like, oh, the Fed's going to ease and money's going to be cheaper to borrow and everyone's going to be so happy. It's like, oh, crap. What if growth actually sucks and unemployment is on the rise and the Fed needs to ease to help a bad economy instead of just like pulling back from the cycle of controlling inflation?
Which also like kind of duh, but yeah.
Oh, it's all, but again, and to be clear, whenever we're talking about market moves and what we think is happening, this is just our interpretation of what we see in the markets and what we hear pundits talking about, either economists, traders on the street talking about flows, you know, the talking heads on CNBC, the Guy Adamis of the world, what have you, right? This is all just a hypothesis about why the market moves a certain way. It might come out in a week that there was some huge structural flow that nobody understood and one person had eyes on, and that's why the whole thing happened. So to be very clear, like this is not written in stone. This is just my interpretation off of everything I read and watching the price action.
Right.
But so on Friday, we started to see the beginnings of a flight to quality trade, which is out of risky assets, selling out of equities, and buying into the front end of the US Treasury curve in anticipation of the Fed cutting rates harder and faster than previously anticipated. Okay, so now here's the kicker. So remember, Japan went home, right? They had already gone off to enjoy their weekend while all this is going down because they're 12, 13 hours ahead. So Monday morning in Japan, Sunday night here in the US, the market's open. And everyone looks at the fact that you've now got a much higher likelihood of Fed eases coming this year, thanks to that employment data in the US, up against the fact that you just had this hike from the BOJ. So what does that mean for dollar yen? Well, again, remember, country with rising rates, their currency should richen. Country that's lowering rates, their currency should cheapen. So that whole dollar yen thing they were worried about providing headwinds to their economy, that's a whole lot bigger problem if the US is cutting rates much faster and much harder than you thought when you left for the weekend. Right. So investors start hammering the Nikkei. It drops 12%, which was, I think, the biggest single day drop since 1987. And it actually hit the circuit breaker, which is when trading on an exchange is temporarily halted to try to calm people down. And even though it's bedtime in the US, people are starting to freak out, okay? Panic begets panic. And if you're trading overnight when liquidity is thinner and moves tend to get exacerbated, it's like, I don't know if your mom ever said this to you. My mom was always like, listen, nothing good happens after 2 a.m. Okay, go home from the bar. Nothing good is going to happen between 2 a.m. and 5 a.m. It's almost always the same rule with trading, okay? So you've got panic in the markets. And when Monday opens in the US, you have a huge sell-off continuing in S&Ps and really global equities, okay? And a big move in the rate markets that finally had that yield curve disinverting, like you said. So 2-year yields dropping below 10-year yields for the first time in over 2 years because everyone's piling into front-end rates in the US, thinking that the Fed is going to cut sooner. And we actually at one point yesterday were pricing in something like a 20 or 25% chance that the Fed was going to do an emergency intermeeting ease.
Really?
Which only happens when like there's a real crisis. Okay. Like things had just reached a fever pitch.
Yeah. That was, I mean, it's funny because I listened to the daily episode this morning and they were like, that's actually like the worst thing that they could do. Cause it's like, by the way, like this actually is a huge deal instead of it being like, guys, chill, calm your horses. Like,
Right. I don't think that was really going to happen. And so when you see extremes like that, you start to question like, okay, what's the realistic outcome here? But there were all these headlines yesterday and today too, about quote unquote, the big unwind, meaning investors unwinding all the trades they've been piling into nonstop in the recent cycle. So that means selling out of tech stocks. And we talked about that 2 weeks ago from this possible factor rotation angle. Okay. Now who knows if it's all one and the same, but we're seeing tech stocks drop. We saw the yield curve steepening, crypto got crushed, and we saw credit spreads, which have been pretty bulletproof of late, widening out. So every trade that has worked over the past cycle got hit really freaking hard yesterday. And we started getting messages from people. Someone was like, I lost 60% of my net worth trading today, asking for our perspective, having lived through other financial crises in the past. And what I said is, listen, like I'm not an equity investor.
Like?
What was the Great Depression like?
It reminds me of that the TikTok meme. It's like, so what was the Great Depression like?
It was
exactly.
Fine. No, it's what was the Great Recession like? Exactly.
Yeah.
But listen, I do remember, not to sound like an old lady, but I remember being on the trading floor when S&Ps hit 666 in 2009.
The devil's number.
I remember people were losing their goddamn minds. And I guarantee you, if you now went and interviewed any one of those traders who were like white as a sheet and been like, oh, like, what were you thinking that day? They'd probably be like, oh, I knew that eventually everything would be fine. And if you ask them if they had like any regrets about how they traded, they'd probably be like, I wish I had just bought everything, right? Mm-hmm. Like my only regret is not buying more at the lows. And like, that's really easy to say now. But the moral of the story, I think, is that volatility creates opportunity. We're recording this at 11 a.m. on Tuesday, and the Nikkei broke the circuit breaker on the way back up, okay? We're getting a classic bounce back pretty much across the board. So the message is really just like, stay calm, keep some powder dry, and try not to get swept up in panic or euphoria. And I mean, there were so many people warning against that euphoria with all of the moves we saw in the tech stocks, with NVIDIA's price, et cetera, et cetera. And everyone kept looking for, okay, well, what's going to be the thing that breaks this? I guarantee if you polled 25 people who were saying that NVIDIA is overvalued or the S&Ps are too high or whatever it was, they weren't going to be like, it's the BOJ that does it. So who knows how much validity there is to this thesis, but that seems to have been borne out by the price action that we've seen over the last 24, 36, 48 hours. And things are at least rebounding somewhat today, but the more you keep a clear head about
tons of volatility,
the better you'll do. Yeah.
I mean, I think it's one of those things where things are never as good as they seem. They're never as bad as they seem, And I think especially these days with so much high frequency trading, you will have situations where people have like limit orders, or they have, like triggers, like you said. It's not triggers where there's like the stopgap, like the halting, but like people will say, hey, if a share price does this, I need to sell, or if this does this, I need to buy. And like, so there's just a lot of, again, the algorithmic trading and all that can cause these just like massive swings.
Well, limit orders actually tend to keep markets in check because people put orders behind the market and above the market. And that actually tends to keep price action contained. What the algos do is they pile on and they exacerbate. So it's not the limit orders. It's the algos who say,
Yeah. But so it's just been a wildly volatile market over the last, and it's probably, I mean, who knows if it continues, but going into obviously the election cycle, like it's another meme these days where it's just like the writer's room and, whoever's writing the scripts, right? Because it's like, go to Veep or go to West Wing, right? The writer's room of whoever is writing July and August 2024. Like if you were to try to get this through for a TV show, they'd be like, I don't know if this is believable. Like
I know. Well, and August is supposed to be a sleepy month because everyone's away for vacation. But what that means actually is that liquidity conditions are much thinner. If you have someone who's seeing this price action on their, I was going to say BlackBerry, but on their phone on the beach, and they're like, oh shit, I was plugged in. Like, what the hell's happening to all my positions? Like Bob, who's like still on the desk, who's 22, who doesn't get to take a summer break. Do something. And Bob's like, I don't know what to do, right? So you can get some crazy conditions like that.
Well, it was funny. There was, again, and I promise we'll stop talking about memes, but there was this other meme. This one person was like, the private markets guys, the private equity, the private credit, they were like, my positions were flat, because that's the thing, right? When you
don't have to mark to market.
Private markets, they don't have to mark to market, but also like when there's the thing with, again, obviously the hedge funds is like, there's like lots of volatility and everyone marks to market. Like your price swings can go up significantly, down significantly. Whereas again, in the private markets, they're kind of like, well, there's lots of volatility in the markets, but like, we're just kind of holding on. And like, we'll see what happens when we need to sell. Like, we need to do an IPO. Like, we'll see where the market is in 5 years.
But they're not sussing out what the mark-to-market value is of something during a move like this. They're like, don't worry about it, guys. We'll mark the books in a month, okay? We'll let you know where we stand.
Yeah. But speaking of which, so there's been obviously, as you were saying, a number of deals that have started to get pulled just because of
I didn't say that, but yes.
Oh, you did it.
That's a great segue. I forgot to talk about that. You can see the future. A bunch of deals got pulled because of the volatility in the markets and credit spreads blowing out.
The one in particular, though, was not actually pulled because of this. Bill Ackman was trying to go out and do an IPO of a closed-end fund. He was hoping to raise, I think, $25 billion, although I could be wrong. If it was
25 billion was the original price target.
that was his price target for how much he wanted to raise versus like the implied equity value of the thing. Okay. So that's what, okay. So he was trying to go out raise $25 billion. And again, it was going to be like this massive fund. Ultimately, he then revised the, I guess how much he was trying to raise. Cause like there wasn't demand for 25 billion. He went down to like 2.5 to 4 billion before ultimately pulling it all together. Yeah. And it was interesting because there's a number of private equity firms that are publicly traded. So if you wanted to buy into KKR or Blackstone, Apollo, a lot of these funds are publicly traded, but there are really like publicly traded hedge funds or again, this like closed-end fund. And it's interesting because again, I love Matt Levine, who always has just really smart takes. And he was kind of describing some of the issues that arose, which was he's trying to go out and raise money. And it's at the end of the day, like when you raise money at this, it's you're raising, like as you're trying to price, where should we set the price target? With most IPOs, right? You go out and you say, what do we think this company is worth? You then see what the demand is, you see what the price ranges are, and you use that to say this thing should be priced here to here. In this case, he's basically going out and he's raising a pile of money. And so if you think about, well, what should it be priced at? It should probably be priced at how much money you're raising, kind of, right? Yeah. And actually, if anything, I mean, maybe a little bit below because there's the underwriting fees associated with doing an IPO, which are oftentimes quite hefty. And so it was interesting in the context of just the whole process of trying to do an IPO for almost like a bag of cash that was going to get invested. And sort of the process of trying to figure out what the right price was. But it's almost like a little bit, it reminds me a little bit of almost like a SPAC in the sense of like, if, when people buy into a SPAC, you're basically buying into this blank check company. And by the way, you can go back and listen to our SPAC episode. That was one of my favorite episodes, by the way. We basically walked through WeWork and used it as like a case study for a failed IPO and then ultimately a SPAC, which also went disastrously wrong. I can't speak. But the point is that it is sort of similar because in that case, like I said, you're basically doing a blank check company IPO. You're IPOing a company about nothing that the only thing that they need to do is go out and basically buy another business. And so you're kind of making a bet on the manager, on the sponsor, actually is what it's called. And so this felt a little similar. But anyway, the moral of the story is that it was not able to get done. TBD if he's going to go out and basically try to do it again at a different time. But it was an interesting case study to see that this ultimately did not go, I think, the way that he was hoping. So that's been a big, I feel like, topic of conversation. And the last thing I want to talk about this just because Jen got me sucked down this rabbit hole. It's actually really funny because
sorry I did.
Well, no. So what happened is we obviously share a TikTok account because we have the Wall Street Skinny TikTok account. I don't think either of us have TikTok otherwise.
No.
Yeah. Well, actually, my babysitter was like, does Jen have TikTok? Because she pointed at like, you have, well, it's basically an impersonator account that has your picture as their, Yeah.
What?
So yes. Anyway, so that is not Jen. Yeah.
Oh my God, I didn't know that.
It's the Wall Street Skinny backup, but they took like your, anyway, it's your picture.
Of me?
Yeah.
Is it a good one at least?
Well, yeah, it's your, yes, it is a good one, but it's like, so anyway, you do, of course. But, so I went on TikTok and I start getting these videos of like people on farms, like making butter. And I was like, what am I watching? Like, what is this? Why am I getting served content related to basically farm life? So I messaged Jen and she was like, yeah, that's because of Ballerina Farm. So there was this whole like scandal that happened. So this one woman has this big TikTok account, Ballerina Farm, was apparently a Juilliard trained ballerina who moved to New York. I think she was raised in a Mormon household, moved to New York, was again studying at Juilliard. Getting into Juilliard, by the way, is like harder than getting into Harvard. Like this is a ridiculous feat. Like this is sort of Olympic level athlete type of skill. Ultimately met this guy who was basically the son of the founder of JetBlue, so a bazillionaire. And he wanted to date her and she sort of wasn't interested. Ultimately, like she got on a flight back to Juilliard from, I guess, Utah, and he happened to be on the seat next to her. Like, how did that happen? It's because he called up his dad and was like, put me on the seat next to this woman. They get married. They obviously, whatever. She leaves Juilliard. Actually, she was the, I guess, youngest person at Juilliard to ever have a baby because, so she left Juilliard, got married, and now has 8 kids and counting, is living on a dairy farm or living on a farm, posting on TikTok. But the controversy was she did this article with the Times of London, and it was kind of getting into just some of the detail, like about how, I mean, again, I can only imagine because I have 3 kids and we obviously have this business together. We create content. And I know how exhausted I am. And I have a nanny. My kids go to school. Like I'm not homeschooling them. And I also only have 3. And I am exhausted. And she is parenting all these kids. I guess they don't have hired help. They don't have a nanny.
They're
I guess they do have,
homeschooled, which you
they're
said.
homeschooled. Yeah, they're
Yeah.
homeschooled. Although I guess she does have a little help with the homeschooling part. And then they're running a business and she's creating content on the side. And I was like, I said to you, I was like, I know how much effort it takes just to create a video. And she's creating these. I'm like, I can't see her on her phone, like editing this stuff while also like raising 8 kids, while also just it. And I can't. So anyway, I mean, it's funny because it's like almost the opposite of, people think of the simple life of just, living on a farm. And it's like, no, this sounds literally harder than anything in the entire world, because not only are you basically parenting all these kids and doing everything, but you're also running a business, like a small business, and creating content. That in and of itself is a full-time job, not to mention raising 8 kids.
Yeah, I mean, the scandal with Ballerina Farm is, okay, what's reality and what's manufactured? And what is her being some kind of pawn in the machinations of some controlling husband figure? And what is her being a willing participant? And I do not know, nor am I qualified to opine on that. The Times article makes it sound like she is this brainwashed, dead behind the eyes, miserable puppet, basically beholden to the whims of this wealthy man who is controlling and who snatched her away from her dream at Juilliard and is turning her into a baby farm on a farm, right? Mm-hmm. And it's very different being a farmer too when you have a $500 million trust fund versus being a sustenance farmer with a $5 bank account, or someone who's truly reliant off the profits from their farm. Farms are notoriously difficult to turn a profit on, and so someone who is truly living that lifestyle without that cushion to fall back on. So the dissonance between what we see, we always talk about social media as the highlight reel,
not real
right?
world. It's not the real world. Yeah.
Well, so it's not the real world on so many levels. And the question is which level is the most problematic? Is it that this is a secretly wealthy family portraying this simple life when they have tremendous access to resources? Is it this is a woman who's been coerced into living this trad wife life and she's secretly crying for help? Or is this a 3D chess game, next level marketing thing where they're getting so much attention?
So much.
She came out and said, I chose this life. I always wanted this big family. And people are like, oh, but she's just being forced to say that because he's telling her to say that. It's like, well, hang on, right? Which is it? She's saying she's happy. And now we're saying, no, she's not. We know better, right? So that's condescending. But also, what if this is some woman who's truly crying for, like, how do you know? Because social media is fake. And that's the whole thing. Social media is fake at the end of the day. So whatever it is, this woman knows the truth of whether or not she's happy in her life. It's not for us to judge, but I'm with you, Kristen, that I think I've always said this. I think being to bring it back to Claudia's song, being a stay-at-home mom, SAHM, I truly think is the hardest job in the world. I cannot imagine doing that with my 2 children, even though I'm like kind of a partially stay-at-home mom. I'm a work-from-home mom who has a flexible schedule as an entrepreneur that I set myself, right? But I send my kids to school. We had help when they were younger. And I do have family helping me all day. So, I have close family here. So I cannot imagine doing that, like you said, and being a full-time content creator and having, even if it's a fake working farm, even if it's a fake working farm, I see her milking the sheep. First of all, I forgot that sheep need to be milked. I wouldn't have, but also, why do they need to be milked? Aren't they just giving milk because they had baby? Anyways, neither here nor there. But I'm with you in that seems impossible. And all the respect in the world to this woman, if she's pulling off any portion of that, regardless of whether or not she's happy, just keeping herself and these kids alive.
Well, her husband literally told the reporter in the article, he was like, sometimes she's so exhausted, she can't get out of bed for a week. I mean, also, duh. Watching the videos, this was also so funny because I saw, as they were writing it up, they're like, people look to this some, idealized life that's simpler, whatever. I'm like, no, I watched this and I am exhausted. I was like, this makes me want to curl up and die. The idea of having to go and, find the food that you're then going to make for your 8 kids while also filming yourself and then needing to clean it all up and then deal with the cows and like everything else, all with
I
like
can
a
barely
4
make it
month
to Whole
old.
Foods.
I'm like, this is giving me so much anxiety. And
Yeah.
maybe it's because obviously you and I both are moms. And so like we kind of had that experience.
We're also
like
city mice by comparison. Like we are,
I
am not a sustenance farmer at all.
No.
I had to kill spiders in Switzerland and I was losing my goddamn mind.
But
I will say, after we came back from Europe, I got a bread maker. And I'm watching this woman with her sourdough starter and whatever. I got a bread maker where you literally, it tells you the ingredients. It tells you how much to measure. You dump it all in. You don't even mix them. Okay. You don't even do so much as a stir. You literally dump them in the order it lists on the paper. You close the lid. You select a button 1 through 14 and you come back in 3 hours and you have bread. And by the way, it pops out so easily, you don't even need to wash it in the dishwasher. It's the best appliance ever. And that's as close as I will ever get to like trad wifing, is making bread with an instant bread maker.
Yeah, the closest I'll get was making my my pizza that one time because my husband's parents got us a pizza maker and then a subscription box where they basically sent us the dough. And I remember when like the dough came, I'm like, I really need this. Can't I just buy the dough that's already prepared from the store?
Can't we just order pizza?
What is this? Yeah, I know, right? I have to like knead this thing. And it actually was pretty good. The pizza was good.
Are you still doing it? Your pizza subscription?
No. It was only like, I think there was 4 months worth that we got. So it's no. we have a nice pizza place down the street. They make great pizza.
Yeah.
It was so funny because when they got us the it as a gift. And again, it was a thoughtful gift. But it was funny. They were like, well, you guys really like pizza. And I was like, my cousin said this, who also was a mom. She was like, I don't think it's because you guys like pizza that much, although I do. She's like, it's because it's easy. It's like, that's the reason.
And kids will eat it. Like my kids
will eat it.
would eat pizza every night of the week if they could. So I think that about wraps it up. We're coming up on 35 minutes, and now you're like stressing me out because I have no groceries. I gotta go get them. I will not be foraging in my backyard for like a dandelion to feed my 6-year-old.
So anyway, thank you guys for being here with us, and we will be back again on Saturday like normal. We have a great episode, a great interview with someone, and the exact person is TBD because we have a bunch of interviews.
We know it's gonna be great. We have
a bunch. Yeah, we have a bunch of interviews this week, and so as we get closer, we're going to decide which one makes the most sense for this weekend.
It's like a cage match, gladiator. Yeah. Who will be on the Wall Street skinny? Whoever has the best interview. I'm just kidding.
So with that, thank you guys so much, and we will see you on Saturday. Bye.
Bye.